In 1965, a 34-year-old investor bought a failing textile company for $7 per share. Today, that same share is worth over $600,000. And the man who orchestrated this transformation became the greatest investor in history with a net worth of $140 billion. His name is Warren Buffett. And the company he built, Berkshire Hathaway, didn't just make money. It revolutionized investment strategy and proved that patient, value-based investing could outperform every other approach. But here's what most people don't know. Warren Buffett's purchase of Berkshire Hathaway was actually a mistake driven by anger. He never intended to run an operating company. But once he owned it, he turned that mistake into the most successful investment vehicle in history. Today, we're breaking down exactly how Warren Buffett built Berkshire Hathaway. The investment philosophy, the legendary acquisitions, the simple lifestyle. This is the complete story of how the Oracle of Omaha became a billionaire by being patient while everyone else panicked. Warren Edward Buffett was born in 1930 in Omaha, Nebraska, during the Great Depression. His father was a stockbroker who later became a congressman. Money was tight, but the Buffett household valued education and hard work. Warren showed an obsession with numbers from childhood. At age 6, he bought 6 packs of Coca-Cola for 25 cents and sold individual bottles for a nickel, making a 5-cent profit. At age 11, he bought his first stock, 3 shares of City Service Preferred at $38 per share. The stock dropped to $27. Warren panicked and held on. When it recovered to $40, he sold, relieved to make a small profit. The stock then soared to $200. Warren learned a painful lesson. Don't sell quality companies just because the price fluctuates. Patience pays. By age 13, Warren was delivering newspapers and filing his first tax return, deducting his bicycle as a business expense. By 15, he'd saved over $5,000 from various business ventures. That's equivalent to over $60,000 today. Warren enrolled at the University of Pennsylvania's Wharton School but found it boring. He transferred to the University of Nebraska, graduating at age 19. He then applied to Harvard Business School. They rejected him, calling him too young. That rejection changed Warren's life. He discovered that Benjamin Graham, the father of value investing, was teaching at Columbia Business School. Warren immediately applied, was accepted, and studied under Graham, learning the philosophy that would make him billions. Graham's approach was simple. Buy stocks trading below their intrinsic value. Treat stocks like partial ownership of businesses, not lottery tickets. Demand a margin of safety. Be rational when others are emotional. Warren absorbed these principles completely. He graduated from Columbia and went to work for Graham's investment firm, Graham-Newman Corporation. He was making $12,000 a year, but he was learning from the master. In 1956, Graham retired and closed his firm. Warren, now 25, returned to Omaha. He started an investment partnership with 7 family members and friends, contributing just $100 himself. The partnership started with $105,000 in total capital. Warren's track record was extraordinary. While the Dow Jones returned 7.4% annually, Warren's partnership averaged 29.5%. He crushed the market year after year. By the early 1960s, Warren's partnership was managing millions of dollars. He was constantly looking for undervalued companies to buy. That's when he noticed Berkshire Hathaway, a textile manufacturing company based in New Bedford, Massachusetts. Berkshire was struggling. The textile industry was dying in America, moving overseas where labor was cheaper. The company was closing mills and liquidating assets. But it was trading below the value of its working capital. By Graham's standards, it was a bargain. Warren started buying shares. He planned to buy, wait for the company to liquidate more assets, sell back to management at a small profit, and repeat. It was a classic value investment play. But then something happened that changed everything. Berkshire's CEO, Seabury Stanton, offered to buy Warren's shares back. They agreed on a price of $11.50 per share. Warren said yes. When the tender offer arrived, it was for $11 3/8, an eighth of a point less than agreed. Seabury had tried to cheat Warren out of 12.5 cents per share. Warren was furious. Instead of selling, he bought more shares. He bought enough to take control of the company. In 1965, Warren fired Seabury Stanton and became chairman of Berkshire Hathaway. Years later, Warren would call this his biggest mistake. Buying Berkshire out of anger meant owning a dying textile business. If he'd invested that money in insurance or other industries, he'd have made billions more. But Warren made the best of it. He kept the textile mills running for another 20 years, trying to honor commitments to workers and the community, but he knew textiles had no future. He needed to transform Berkshire into something else. The answer was insurance. Insurance companies collect premiums upfront and pay claims later. That creates float, money that can be invested while waiting to pay claims. If you invest the float well, insurance is incredibly profitable. In 1967, Berkshire bought National Indemnity, an insurance company, for $8.6 million. This acquisition changed everything. Suddenly, Berkshire had float to invest. Warren could take the premiums coming in and deploy them into undervalued stocks and businesses. Warren's strategy was elegant. Use insurance float to buy great businesses. Let those businesses grow and generate more cash. Use that cash to buy more businesses or stocks. Compound the returns over decades. By the early 1960s, Warren's partnership was managing millions of dollars. He was constantly looking for undervalued companies to buy. That's when he noticed Berkshire Hathaway, a textile manufacturing company based in New Bedford, Massachusetts. Berkshire was struggling. The textile industry was dying in America, moving overseas where labor was cheaper. The company was closing mills and liquidating assets. But it was trading below the value of its working capital. By Graham's standards, it was a bargain. Warren started buying shares. He planned to buy, wait for the company to liquidate more assets, sell back to management at a small profit, and repeat. It was a classic value investment play. But then something happened that changed everything. Berkshire's CEO, Seabury Stanton, offered to buy Warren's shares back. They agreed on a price of $11.50 per share. Warren said yes. When the tender offer arrived, it was for $11 3/8, an eighth of a point less than agreed. Seabury had tried to cheat Warren out of 12.5 cents per share. Warren was furious. Instead of selling, he bought more shares. He bought enough to take control of the company. In 1965, Warren fired Seabury Stanton and became chairman of Berkshire Hathaway. Years later, Warren would call this his biggest mistake. Buying Berkshire out of anger meant owning a dying textile business. If he'd invested that money in insurance or other industries, he'd have made billions more. But Warren made the best of it. He kept the textile mills running for another 20 years, trying to honor commitments to workers and the community, but he knew textiles had no future. He needed to transform Berkshire into something else. The answer was insurance. Insurance companies collect premiums upfront and pay claims later. That creates float, money that can be invested while waiting to pay claims. If you invest the float well, insurance is incredibly profitable. In 1967, Berkshire bought National Indemnity, an insurance company, for $8.6 million. This acquisition changed everything. Suddenly, Berkshire had float to invest. Warren could take the premiums coming in and deploy them into undervalued stocks and businesses. Warren's strategy was elegant. Use insurance float to buy great businesses. Let those businesses grow and generate more cash. Use that cash to buy more businesses or stocks. Compound the returns over decades. Throughout the 1970s and 1980s, Warren built Berkshire methodically. He bought See's Candies for $25 million in 1972. It was generating $4 million in profit annually. The owner wanted $30 million. Warren refused and walked away. The owner came back at $25 million. Warren bought it. See's Candies became one of Warren's best investments. It generated massive cash flow that he could reinvest. And it taught him an important lesson. Quality businesses with pricing power and brand loyalty are worth paying up for. Warren invested Berkshire's money in public stocks. He bought major stakes in the Washington Post, Geico Insurance, Coca-Cola, and American Express. He didn't trade in and out. He bought and held for decades. His Coca-Cola investment became legendary. In 1988, Warren started buying Coke stock. He eventually invested $1.3 billion. Today, that position is worth over $25 billion. And Berkshire collects over $700 million in annual dividends from Coke alone. Warren's approach was different from every other investor. He didn't care about quarterly earnings. He didn't follow market trends. He didn't use complicated financial instruments. He just bought great companies at fair prices and held them forever. This approach made Warren very wealthy. By 1985, Berkshire Hathaway stock was trading at $2,700 per share. Warren's personal stake was worth hundreds of millions. But he kept living in the same modest house he'd bought in Omaha in 1958 for $31,500. Warren's lifestyle became part of his legend. He drove a regular car. He ate at McDonald's for breakfast. He lived simply, almost frugally. While other billionaires bought yachts and mansions, Warren stayed in Omaha and focused on finding good investments. But Warren wasn't just buying stocks. He was acquiring entire companies. In 1983, Berkshire bought Nebraska Furniture Mart. In 1986, Scott Fetzer Company. In 2003, Clayton Homes. These weren't flashy tech startups. They were boring, profitable businesses that generated steady cash flow. Warren looked for companies with 4 characteristics: strong competitive advantages, excellent management, good return on capital, fair price. If a company met these criteria, he'd buy it. Then he'd leave management alone to run the business. As Berkshire grew, Warren started making bigger bets. In 2008, during the financial crisis, Warren invested $5 billion in Goldman Sachs. Everyone thought he was crazy. The financial system was collapsing. Banks were failing. But Warren saw opportunity. He negotiated warrants that allowed Berkshire to buy Goldman stock at favorable prices. When the crisis ended, that investment generated billions in profit. Warren had once again bought when everyone else was panicking. The same year, he invested $3 billion in General Electric. He made similar deals with Bank of America later. Each time, Warren got preferred stock with high dividend rates and warrants to buy common stock. He wasn't just helping companies survive. He was making sure Berkshire got compensated for taking the risk. Warren's biggest acquisition came in 2009. Berkshire bought Burlington Northern Santa Fe, one of America's largest railroads, for $26.5 billion. It was Berkshire's largest purchase ever. Some analysts questioned buying a railroad in the digital age. Warren saw it differently. Railroads have natural monopolies. They're the cheapest way to move freight over long distances. As long as America needs to move goods, railroads will be profitable. It was classic Buffett thinking. Buy essential infrastructure at a fair price. The railroad acquisition proved brilliant. BNSF generates over $5 billion in annual profit for Berkshire. It's become one of the company's most valuable assets. Warren also made massive investments in Apple. Starting in 2016, Berkshire bought Apple stock aggressively. This was unusual for Warren. He'd traditionally avoided tech stocks because he didn't understand them. But he saw Apple differently. Apple wasn't a tech company. It was a consumer products company with a cult-like brand. Apple customers were fanatically loyal. They paid premium prices. They upgraded regularly. Warren understood consumer behavior, so he bought. Berkshire invested $36 billion in Apple. That stake is now worth over $150 billion. It's Berkshire's largest holding and one of Warren's most profitable investments ever. Warren Buffett's success isn't just about smart investments. It's about philosophy. He developed a set of principles that guided every decision. First, the circle of competence. Warren only invests in businesses he understands. He doesn't buy biotech stocks or complex derivatives. If he can't explain how a company makes money, he doesn't invest. This discipline saved him from countless bad investments. Second, margin of safety. Warren never pays full price. He waits for companies to go on sale. A great company at an okay price beats an okay company at a great price. But a great company at a great price is best. Third, long-term thinking. Warren measures success in decades, not quarters. His favorite holding period is forever. This allows compounding to work its magic. A 10% annual return doubles your money in 7 years. Over 50 years, it multiplies by 117 times. Fourth, emotional discipline. Warren is rational when others panic. He's cautious when others are greedy. His famous quote captures this perfectly. Be fearful when others are greedy, and greedy when others are fearful. Fifth, management quality. Warren invests in businesses run by people he trusts. He looks for managers who love their business, treat shareholders fairly, and think long-term. Then he gives them complete autonomy. Warren's annual shareholder letters became required reading for investors. He wrote in plain English, not financial jargon. He explained his thinking, admitted his mistakes, and shared his wisdom. These letters taught millions of people how to think about investing. Warren also became famous for his partnerships. His friendship with Charlie Munger, Berkshire's vice chairman, lasted over 60 years. Charlie challenged Warren's thinking, expanded his circle of competence, and helped him avoid mistakes. Warren credits Charlie with transforming him from a Graham-style value investor to one who would pay fair prices for great businesses. In 2006, Warren shocked the world. He announced he would give away 99% of his wealth to charity. He'd give most of it to the Bill and Melinda Gates Foundation. Warren was worth $44 billion at the time. This wasn't just charity. It was the most efficient wealth transfer in history. Warren realized he was good at making money, not giving it away. The Gates Foundation had expertise in philanthropy, so he'd let them deploy his wealth while he kept compounding it. Warren's giving pledge inspired other billionaires. Along with Bill and Melinda Gates, he launched the Giving Pledge, asking billionaires to commit at least half their wealth to charity. Over 200 billionaires have signed. But Warren kept running Berkshire. As of 2024, at age 94, he still serves as chairman and CEO. Berkshire Hathaway is now worth over $1 trillion. The company wholly owns over 60 businesses, employing nearly 400,000 people. Berkshire's portfolio includes Geico Insurance, BNSF Railroad, Dairy Queen, Duracell, Fruit of the Loom, and dozens more. It also holds massive stock positions in Apple, Bank of America, Coca-Cola, and American Express. Warren's personal net worth exceeds $140 billion, making him one of the 10 richest people on Earth. But he still lives in that same Omaha house, still eats McDonald's for breakfast, still reads annual reports for hours every day. Warren's succession plan is finally in place. Greg Abel will become CEO when Warren steps down or passes away. The company's culture and philosophy will continue. But everyone knows there will never be another Warren Buffett. So how did Warren Buffett build Berkshire Hathaway? Through patience, discipline, and rational thinking. Through buying great businesses at fair prices and holding them forever. Through living simply and letting compound interest work its magic over decades. Warren proved that you don't need to trade frantically to get rich. You don't need insider information or complex strategies. You just need to find great companies, buy them when they're undervalued, and wait. From a $7 textile stock to a $600,000 share price. From managing $100,000 to running a $1 trillion empire. From a young investor in Omaha to the Oracle who millions seek advice from. Warren Buffett's story is one of patience, wisdom, and compound interest. He made investing simple when everyone else made it complicated. He stayed rational when everyone else panicked. He thought in decades when everyone else thought in quarters. Berkshire Hathaway proves that boring, patient, value investing beats everything else over time. And Warren Buffett proves that you can become incredibly wealthy while living simply and giving generously. The $7 mistake that Warren bought in anger became the vehicle for one of history's greatest fortunes. And the man from Omaha became the greatest investor who ever lived. If you found this breakdown of Warren Buffett and Berkshire Hathaway's rise fascinating, make sure you hit that subscribe button. We're covering the most incredible investment strategies and business empires built by financial legends. Drop a comment below. What other legendary investors should we cover next? Charlie Munger? Ray Dalio? Peter Lynch? George Soros? And if you want to learn Buffett's actual investment strategy, check out our video breaking down his portfolio stock by stock. The link is in the description. Thanks for watching. I'll see you in the next one.